Hey everyone, and welcome to another deep dive.
Yeah, pumped for this one.
This time we're tackling financial acumen.
Which is
Yeah.
a really fascinating topic.
Yeah, super important too.
It is. And it's one of those things that,
Yeah,
it's not something that's usually formally taught or anything like that, but
right.
it's something that you kind of have to pick up as you go along.
Yeah, it's kind of learn as you go.
Exactly. Yeah. And so today we're going to be looking at a bunch of different sources that you've provided.
Yeah, a ton of stuff about financial acumen.
Yeah. And so the mission here is to really pull out kind of the core principles and the key insights from all this material and, make it something that's actually applicable and actionable for our listeners.
Exactly. Forget all the dry textbook definitions and stuff.
Right.
We want to make this fun, interesting, and most importantly, give people the power to make
Yes.
smarter decisions about their money.
Absolutely.
So looking at this material, we've got 11 key components of financial acumen.
Yeah.
We've got everything from understanding those, sometimes intimidating
Yes.
financial statements.
The balance sheet,
Yeah.
the income statement, cash flow statement, all that fun stuff.
Right. All the good stuff we've got. Financial ratios and metrics, budgeting and forecasting. Oh, that's
Yeah.
a fan favorite.
Oh, love that one.
We've got investment knowledge. That's where things get exciting, right?
Yeah, absolutely. And understanding, risk and return.
Capital structure and financing.
Yes.
Risk management. Oh, this is good. Cost management and profit maximization.
That's crucial.
Right. Economic and market understanding. Taxation and compliance. Ugh. Yeah, no one loves that one.
No, but important.
But we've got to cover it. And then, of course, financial decision making.
Yeah, bringing it all together.
So are you ready to dive in?
Let's do it.
All right. Let's start with those financial statements. I mean, those things can seem like a foreign language sometimes.
They can. It's true.
Especially if you don't.
Especially if you don't look at them every day.
Right. Exactly.
But I always think about it's these financial statements are kind of like a company's autobiography, right?
Ooh, I like that.
Yeah.
Like their story.
Yeah, they're telling their story, and there's three main chapters.
Okay.
The income statement, the balance sheet, and the cash flow statement. Each one kind of reveals a different part of their financial journey.
Okay. So let's start with the income statement.
Yeah.
That's kind of like a company's profit and loss report.
It is.
Right.
It is that kind of...
Shows how much revenue they brought in, how much they spent, and then what was the resulting profit or loss over a given period.
Got it. So it's kind of like a snapshot of...
A snapshot of their performance.
Yeah. Okay. So if I'm looking at a company's income statement, what are some red flags that I should be watching out for? Well, I mean, one thing would be just are their revenues consistently declining? Is that
never a good sign.
not a good sign?
Right.
Are expenses going up and up and up and up? Over time, especially if revenue's not growing at the same time or even faster. Another thing to look at would be what's the profit margin?
Profit margin. Okay.
That's basically telling you for every dollar of revenue that they bring in, how much are they actually keeping as profit?
Okay. Got there.
So if you see a shrinking profit margin over time, that might tell you that they're struggling with, their costs or their pricing strategy or something like that.
Yeah. Makes sense. So income statement, that's all about kind of tracking the profitability over time.
Yes.
But what about the balance sheet?
So the balance sheet, this one is a snapshot in time, right? It's not over time.
Okay.
It's at this moment in time,
Right.
this is what the company, looks like financially.
Mm.
So it shows what a company owns. Those are its assets,
That's how
and it owes liabilities.
liability.
And then the difference between those two, which is the equity or the net worth of the company.
All right. So if I'm thinking about investing in a company,
Yes.
the balance sheet can kind of give me a sense of their overall financial health.
Absolutely.
Right.
A strong balance sheet will show a healthy amount of assets
Okay.
compared to liabilities. You want to see that they have enough resources to cover their debts
Right.
and continue operating.
Okay. And then we've got the cash flow statement.
The cash flow statement.
What's that all about?
So the cash flow statement is really all about tracking the movement of cash, right?
Right.
Where's the cash coming in?
Okay. The money trail.
The money trail. Exactly. It shows how much cash is coming in from their operations,
Okay.
from their investing activities, and from financing activities, and how much is going out, right? So it's really important because a company can be can be profitable on paper,
Oh, interesting.
but still be having cash flow problems.
Okay. So even if a company's like making a profit, it's still important to look at like well, whether they're actually generating cash.
Yes, are they actually generating cash?
Got it.
Um, because a healthy cash flow means that they can pay their bills on time.
Right.
They can invest in growth and they can kind of, weather any unexpected storms.
Right. Like those rainy days.
Exactly.
So we've got our three main financial statements: income statement,
Yep.
balance sheet,
Balance sheet.
cash flow statement.
Cash flow statement.
Now, how do we actually use this information to really analyze a company's financial performance?
Yeah.
Like, are there tools or tricks of the trade?
So that's where financial ratios and metrics come in.
Okay.
These are like powerful lenses that can help us kind of zoom in on specific aspects
Okay.
of a company's financial health. So rather than just looking at those raw numbers.
Okay, so you're taking those statements and kind of making them into like actionable insights.
Exactly.
Yeah, okay.
And there's different categories of ratios. There's profitability ratios, which tell us how effectively a company is generating profit.
Okay, profitability, that makes sense.
And so one key ratio is gross profit margin, which focuses on the profit that a company makes after deducting the direct costs of producing those goods or services.
Okay, so if I'm like comparing two companies in the same industry
Yeah.
and one has a higher gross profit margin,
Yeah,
does that mean they're probably managing their like production costs more efficiently?
they are. They're either, really good at managing their costs or they've got really strong pricing power.
Got it. Got it.
And then you've got net profit margin, which is kind of like takes into account all expenses, not just those directly tied to production.
Okay, so it gives you more of a broader view.
Yeah, it gives you a broader view of a company's overall profitability.
Okay, so we've got profitability ratios. What about liquidity? Like, how could we tell if a company is going to like be able to pay its bills on time?
So liquidity ratios.
Yeah.
So one of the common ones is the current ratio, and this compares the company's current assets, which are things they can quickly convert to cash, to
Yeah.
their current liabilities, which are the short-term debts that they need to pay.
Okay.
So a healthy current ratio basically means that they have enough liquid assets
Yes.
on hand to cover their short-term obligations.
Got it.
And I think earlier we were talking about the quick ratio.
Yeah. How's that different from the current ratio?
So the quick ratio is even more conservative.
Oh, okay.
It actually excludes inventory from current assets.
Oh, interesting.
Because inventory can be tricky, right?
Got it.
Sometimes it's slow to turn into cash.
Oh, right. Okay.
So it gives you kind of a stricter view.
like a more stringent view.
More stringent view
Okay.
of the company's ability to meet those really immediate
Immediate debt.
debt obligations.
Okay. So if I'm really like looking for a company that has a super strong ability to cover those short-term debts,
Yeah,
I'm really zeroing in on that quick ratio.
you're zeroing in on the quick ratio.
Got it.
Now, another area that's really important is leverage, and this refers to a company's use of debt.
Debt.
Yeah,
Okay.
and so one of the key ratios here is the debt to equity ratio, which basically compares the company's total debt to its shareholder equity.
Okay. So a high debt to equity ratio, does that mean that the company is like relying more on borrowed money
They are.
to finance their operations?
They are, exactly. And while some debt can be healthy,
Sure.
too much debt can put a company at risk,
Right.
especially if economic conditions change or if interest rates rise.
That makes sense. It's kind of like taking on like a big mortgage or something, right?
It is.
Like it can be manageable, as long as you can afford the payments.
Yeah.
But if things get tight, it can be
Yeah, it can get really.
a real burden.
Yeah.
So we've got profitability, we've got liquidity, we've got leverage. Is there another one?
There's one more that we'll touch on today, and that's efficiency.
Efficiency.
And efficiency ratios really look at how effectively a company is utilizing its assets.
Okay, so like how quickly they're selling their inventory or collecting payments from customers.
Exactly, things like that.
Okay.
So one of the key efficiency ratios is the asset turnover ratio,
Asset turnover ratio.
which basically measures, how effectively are they using their assets to generate sales.
Okay.
And generally speaking, a higher asset turnover ratio, usually indicates greater efficiency.
Okay. So we've got a whole toolbox of ratios here to help us kind of analyze these financial statements. But let's be honest.
Right.
Sometimes just the thought of budgeting and forecasting can make people want to like run for the hills. You know.
Yeah. You know, it's funny. Those two words, I feel like they have such a negative connotation.
Right. Exactly.
But the thing is, like, budgeting
Yeah.
doesn't have to be this like dreaded chore.
Uh,
It's really about, taking control
right.
and making conscious choices about how you're using your money.
Okay. So it's more about like creating a roadmap for your finances
Exactly.
and kind of helping you prioritize your spending
Yeah, avoid those unnecessary expenses.
and stay on track
And stay on track.
to reach your goals.
Oh, absolutely.
Okay. And forecasting, is that kind of like it goes hand in hand
It does.
with budgeting, right?
Yeah. Forecasting is really about projecting those future financial scenarios, kind of like doing a what-if analysis.
Okay. So like what if my sales increase by 10% next year?
Exactly. Or what if inflation keeps going up?
Right.
How's that going to affect my budget?
Right. So it's about kind of being prepared and adaptable
Yes.
rather than just kind of reacting to whatever
Reacting to whatever comes your way.
comes your way. Okay.
Exactly.
So do you have any like simple tips like for people who are?
I do.
Okay.
When it comes to budgeting, I think one of the most simple but effective things is to track your spending.
Yeah.
Like actually track where your money is going for a month or two.
Oh, yeah. Do that before you even like create a budget.
Before you even try to create a budget, because you might be surprised
Right.
where it's all going. And then once you kind of have a good understanding of that,
Yeah.
then you can start to set realistic spending limits based on your income and your goals.
Okay, that's a great tip. All right, now let's talk about something a little bit more exciting.
Yes.
Investments.
Investments.
Right. I mean, that's where things can get.
This is where things get fun.
Yeah.
It's all about putting your money to work for you.
Right. Yeah.
With the goal of growing it over time.
Okay.
But it's not just about, picking stocks and hoping for the best. There's a whole world of investment options out there.
Okay, so let's break it down. We've got stocks, we've got bonds, real estate, mutual funds, ETFs.
Yeah.
What are like some of the key differences?
So stocks represent ownership in a company, right?
Yeah.
When you buy a share of stock, you're essentially buying a tiny piece of that company.
Okay.
So stocks have the potential for high growth,
Okay.
but they also carry higher risks.
Yeah. So stocks, those are for the people who are a little bit more comfortable
Exactly.
with risk.
Right, and looking for potentially higher returns over the long term.
Long term. Okay.
Yeah.
What about bonds?
So bonds are different. Bonds are essentially loans
Okay.
that you make to governments or corporations.
Okay.
So you're lending them money,
Okay.
and they're promising to pay you back with interest.
Okay. So bonds, those are generally like lower return,
Lower return, yeah.
but less risky.
Yeah, generally considered less risky than stocks.
Okay, so bonds more about stability and income.
Yeah, income generation.
Stocks more about growth potential.
Growth potential.
Got it. Real estate.
Real estate. So real estate is a tangible asset, right? You're actually investing in property.
Yeah, like a building or land.
Yeah.
Huh.
And it can appreciate in value over time.
Okay.
It can generate rental income.
Right.
It's a popular choice for a lot of investors.
Sure.
But it also comes with, its own set of considerations like property management and market fluctuations and things like that.
Yeah, so it's a little bit more hands-on
Yeah.
than just buying a stock or a bond.
A little bit more.
And it's really tied to
Yeah, tied to a specific location.
a specific location.
And
Yeah.
the market.
Okay.
Right.
What about mutual funds and ETFs?
So mutual funds and ETFs, these are pooled investments that allow you to diversify
Okay.
across a basket of assets.
Oh, diversification. That's a key concept.
It is. So instead of picking, individual stocks or bonds, you're basically buying into a fund that holds a diversified portfolio.
Got it. So it's like instant diversification.
It is. It's a way to kind of spread your risk and potentially smooth out your returns.
That sounds a lot less intimidating than trying to pick all the individual stocks myself.
It can be. It can be.
But speaking of risk, I think that's a really important concept
It is.
to understand when it comes to investing.
Absolutely.
Right.
Yeah. One of the fundamental principles of investing is the relationship between risk and return.
Okay.
So, the higher the potential return, the more risk you generally have to take on.
Okay. So if I'm really looking for like a safe investment. I shouldn't be expecting
I'm probably not going to get huge returns.
huge returns.
Yeah.
Okay.
And understanding your own risk tolerance is really crucial when making investment decisions.
Yeah, because everyone's a little bit different, right?
Absolutely. You know, somebody who's nearing retirement might have a very different risk tolerance than somebody who's, just starting out in their career.
Right. They've got a longer time horizon.
Much longer time horizon.
Okay. So how do we manage risk? Like when it comes to investing, what are some...
One of the most powerful tools is diversification.
Diversification.
Remember that old saying, don't put all your eggs in one basket?
Oh, yeah, I've heard that one.
That's basically the essence of diversification.
Okay, so instead of putting all my money in like one stock or one type of investment,
Right.
I need to spread it around a little bit.
Spread it across different asset classes, different sectors, different geographic regions, potentially.
Right. And I imagine like mutual funds and ETFs, that's a good way to kind of get some built-in diversification.
Exactly. They offer built-in diversification.
Okay, so we've covered, the basics of these different investment types, the importance of risk management. But like, how do companies actually raise the money that they need to operate and grow? Like, where does that capital come from?
So there's basically two main ways that companies raise capital. There's debt financing and there's equity financing.
Okay, so debt financing, that's essentially like borrowing money.
It is, right.
Right, like taking out a loan.
Taking out a loan from a bank or issuing bonds.
Right, okay.
And they're obligated to repay that principal plus interest over time.
Yep.
Now, equity financing is a little bit different. That involves selling ownership shares in the company.
Okay, so it's kind of like bringing on investors.
It is. It's bringing on investors who essentially become part owners of the business.
And they get a share of...
And they get a share of the profits and potential future growth.
Okay, so there's pros and cons to both, I imagine.
Absolutely. Debt financing can be less expensive than equity financing in the short term.
Okay.
But it can also put a strain on cash flow if a company has to make large interest payments.
Right.
Whereas equity financing doesn't require repayment.
Okay.
But it does dilute ownership.
Okay.
And can sometimes give investors a say in how the business is run.
Right. So it's kind of a balancing act.
It is.
Yeah.
Yeah. Companies need to carefully weigh those different factors.
Okay. Now, speaking of making these strategic decisions, risk management is something that businesses have to think about all the time.
Right. All the time. Yeah. Because risk is inherent in any business.
Right. So it's not about eliminating risk altogether.
Not about eliminating risk.
It's about kind of minimizing the potential impact.
Exactly.
Whoa.
So it's about identifying what are those potential risks.
Yeah.
Assessing their likelihood and potential impact, and then putting in place strategies to mitigate those risks.
We talked about diversification as a key kind of risk management strategy when it comes to investing. But like, what are some other tools that businesses can use?
So one common strategy is hedging, which involves using financial instruments to kind of offset potential losses.
Okay.
So, for example, a company that imports goods from, overseas.
Okay.
They might use currency futures to kind of protect themselves against, fluctuations in exchange rates.
Oh, okay.
So if the value of that foreign currency drops, the gains from that currency futures contract can help offset the losses from, the higher import costs.
Oh, interesting. So it's kind of like having like an insurance policy against currency movements.
It is.
Okay.
And speaking of insurance, that's another common risk management tool.
Sure. So it's about having that safety net in case things go wrong.
Exactly. And, effective risk management is not just about avoiding losses. It's also about seizing opportunities and making calculated risks that can lead to greater rewards.
Okay, so we've covered a lot of ground here. We've gone from analyzing financial statements to understanding investment strategies to managing risk.
Managing risk.
Let's shift gears a little bit now and talk about cost management and profit maximization.
Yeah. I love this topic.
Okay, great.
So this is really about, how do companies control their expenses and boost their bottom line?
So are we talking about things like negotiating better deals with suppliers?
Absolutely.
Or finding ways to streamline operations.
Yeah, and it starts with understanding the difference between fixed costs and variable costs.
Okay, remind me again, like, what's the main distinction?
Yeah. So fixed costs are expenses that stay pretty much the same
Okay.
regardless of how much you're producing. Oh. So things like rent, salaries, insurance premiums.
Okay, it's fixed no matter.
Fixed.
Yeah.
No matter what. Variable costs, those fluctuate with production volume.
Okay.
So things like, your raw materials, your direct labor, your shipping costs.
Okay, so if a company wants to like reduce their expenses, they've got to look at both of those two categories
Yes.
and kind of figure out
how to cut back.
where they can cut
Exactly.
without sacrificing quality or output.
Without sacrificing quality.
Yeah, that's important.
Yeah.
Now, you mentioned break-even analysis.
A break-even analysis. Yes.
What exactly is that?
So break-even analysis helps businesses figure out the point at which their total revenue equals their total costs.
Okay.
So this is the point where they start making a profit.
So it's kind of like finding that magic number where they're no longer in the red.
Exactly.
Yeah.
They're finally in the black.
In the black.
Okay.
And then pricing strategies.
Yes.
Those play a big role
Huge role.
in maximizing profit.
Right. So, finding that sweet spot
Yeah.
that balances, revenue and demand
Okay.
is essential for success, right? Charge too much.
Yeah.
You might lose customers, charge too little, you might not cover your costs.
So it's like a delicate dance.
It is a delicate dance.
Okay, so we've talked about a lot of internal factors that influence a company's kind of financial performance.
Yes.
But let's not forget about, the economy, the market, all those external,
It's the big picture.
the big picture stuff.
Yeah.
Because, companies don't operate in a vacuum.
No, they don't.
I mean, the economy, interest rates, consumer confidence,
All of it.
it all plays a role, right?
Absolutely.
So how do we even begin to kind of wrap our heads around,
The economy.
yeah, all the complexities of the economy?
So we can start by kind of breaking economics down into two key areas. There's macroeconomics, which really focuses on the big picture.
Okay.
Looking at things like inflation, unemployment, interest rates, government policies, all those big forces that shape the overall economic environment.
So macroeconomics is about kind of understanding those big forces that are shaping
Yes.
the landscape.
The landscape.
Okay.
And then you have microeconomics, which kind of zooms in on individual economic behavior, right? So looking at things like, how consumers make choices,
Oh, okay.
how businesses make decisions, the forces of supply and demand.
So micro is kind of how individuals and businesses are making decisions.
Yeah, within that broader context, within that broader
Got it.
macroeconomic context.
And I think it's also important to stay informed about market trends.
Right.
Both within specific industries.
Yes.
And just kind of the broader economy.
Because, staying informed about those trends can really help you anticipate those shifts and make more informed choices.
So we're talking about changing consumer preferences, technological advancements, even like geopolitical events.
All of it. All of those things can have a big impact on businesses and investments.
Okay. So are you ready to talk about everyone's favorite topic?
Oh, yeah. Let's do it.
Taxation compliance.
Yeah. While taxes may not be the most exciting subject,
No, not really.
understanding them is really essential
It's important.
for your financial well-being, both personally and professionally.
So where do we even start?
Well, I mean, tax planning is key.
Okay.
It's really about taking advantage of, legitimate strategies to try to minimize your tax liability.
Okay, that makes sense.
And this might involve things like, utilizing.
Wow, it's incredible how much ground we've covered already. But you know what I'm realizing? Financial acumen, it's not just about numbers and formulas. It's kind of like
It's a mindset.
a mindset shift, yeah.
It really is. It's about feeling empowered to make, conscious, informed choices about your money rather than just feeling like you're reacting to whatever life throws your way.
Oh, it's like going from feeling lost in a financial fog to suddenly having like a clear map and a compass.
And the best part is anyone can develop these skills.
Yeah, that's a good point.
It doesn't require some, fancy degree or Wall Street background.
Right.
It's really about, just a willingness to learn
Right.
and apply these concepts to your own life.
Okay, so let's just kind of recap some of the key takeaways from our deep dive so far.
Okay, great idea.
We started by demystifying those sometimes intimidating financial statements.
The income statement,
The income statement,
the balance sheet.
the cash flow statement. Cash flow statement. Those are like a company's financial DNA, right?
Oh, yeah.
Kind of reveal
Yeah.
like their profitability, their assets, their debts, how they're managing their cash.
Yeah, how they're using that cash.
Yeah.
And then we talked about how to use those key ratios, like gross profit margin, current ratio, debt to equity ratio.
Yeah, those can really give us some deeper insights into a company's financial health.
They can.
And help us make, smarter investment decisions.
Or informed decisions, yeah.
It's like having that secret decoder ring.
Yes.
To understand a company's financial story.
I love that analogy, the secret decoder ring.
We also tackled those sometimes dreaded topics of budgeting and forecasting, but we reframed them as tools for empowerment.
Yes.
Helping us take control of our finances and plan for the future.
Planning is key.
So budgeting's all about, creating that roadmap for our money.
Yes.
And forecasting is about anticipating those what-if scenarios so we can
be proactive.
Be proactive and adapt.
Yes.
We also delved into that exciting world of investing,
Yeah.
exploring different asset classes, like stocks, bonds, real estate, mutual funds, ETFs.
So many options.
Yeah, and we talked about the importance of understanding risk and return and how diversification can really help us mitigate that risk.
Right.
By spreading our investments across different baskets.
Don't put all your eggs in one basket.
Exactly.
Very good.
We even uncovered how companies actually raise that capital, that money that they need.
Yes.
Through debt financing and equity financing. And we learned about the cost of capital.
Yes.
And how that impacts their decisions.
Absolutely.
And let's not forget about risk management, right?
Oh, super important.
We explored strategies like hedging and insurance, and emphasized the importance of protecting ourselves against those potential financial setbacks. We dug into the art of cost management and profit maximization, understanding the difference between fixed and variable costs, and even those tools like break-even analysis.
Break-even is crucial for businesses.
Yeah.
Really is.
And we talked about the importance of staying informed about economic and market trends.
Yes.
Because those can have a big impact on our finances, both personal and in business.
Absolutely. That broader economic landscape can really have a ripple effect on our lives.
And of course, we couldn't forget about taxes.
Everyone's favorite.
We explored tax planning strategies, common deductions, even that concept of capital gains, and really emphasized the importance of tax compliance.
Compliance is key.
Making sure we're doing things by the book.
Exactly.
It's really amazing how all these pieces kind of fit together.
You do?
To form this comprehensive picture of financial acumen.
It's like a big puzzle.
It is.
And we're putting all the pieces together.
Yeah. Now that we have this solid foundation, let's actually explore some of those key concepts that drive those sound financial decisions.
Okay, sounds good.
So we're talking about those mental models that can really help.
The mental models, yeah.
Make smarter choices.
Smarter choices.
With our money.
Absolutely.
One crucial concept, I think, is opportunity cost.
Opportunity cost. So important.
It's that idea that choosing one option means foregoing others, right?
You're giving up something.
You're giving something up.
Yeah.
So if I decide to, invest my savings in a new business venture, I might be giving up the opportunity to use that money for a down payment on a house.
Exactly.
Or if I, decide to buy a fancy new car, I might be giving up the opportunity to travel the world or something.
It's all about those trade-offs.
Trade-offs, yeah.
Recognizing that every choice we make comes with a cost.
Even if it's not like immediately obvious.
Even if it's not immediately apparent.
Right.
I know I've definitely been in situations where I've made a purchase and then later on I was like, oh man, I wish I had that money for something else.
Yeah, me too.
But becoming more aware of that concept of opportunity cost, I think can really help us make more deliberate,
more thoughtful decisions.
More thoughtful, yes. Yeah. So it's really about asking yourself, what am I giving up by choosing this option?
Okay. Now, another key concept, and this one, I struggle with this one sometimes, is time value of money.
Time value of money. Yeah, that's a big one.
It's that idea that money today is worth more
Yes.
than the same amount in the future.
Due to inflation
Right.
and the potential to earn returns on investments.
So if I have, $1,000 today,
Yeah.
it's potentially worth more than $1,000 a year from now
It is.
because I could invest that money
You could.
and it could
Definitely.
potentially earn interest
Yeah.
or return.
Yeah. That's why it's so important to start saving and investing early.
Yeah, I've heard that that's one of the biggest things, right?
Huge.
Like the earlier you start, the better.
It is.
And this concept really plays a big role in things like retirement planning.
Absolutely.
Right.
Yes. The sooner you start saving for retirement, the more time your money has to grow through the power of compound.
I'm pounding, yeah.
It's like financial magic.
It is. It's like a snowball rolling
Yeah.
down a hill, right?
It is.
The longer you let it roll,
The bigger it gets.
the bigger it gets.
Exactly.
And all these different retirement savings plans available.
Yes, 401k, IRAs, and these plans offer tax advantages that can really help your savings grow.
So it's not just about saving. It's also about being smart about how and where you save.
Absolutely.
Okay, let's move on to debt management,
Debt management.
which can be a really tough topic for a lot of people.
It can feel overwhelming for a lot of folks.
I think debt is just it's something that so many people struggle with.
Struggle with, absolutely.
And it can feel like a real burden.
Yeah, it can be stressful.
But you know what? Not all debt is bad.
It's true.
I've heard that. Like there's
good debt and bad debt.
good debt and bad debt.
Yes.
What are some examples of good debt?
So good debt is typically, debt that you're using to invest in something.
Oh, okay.
That's going to appreciate in value over time.
Okay.
So things like, a mortgage for a home
Oh.
or a student loan.
Okay. So you're
You're investing in your education.
you're investing in.
So even though you're paying interest on those loans,
Right.
you're also building equity in your home.
Okay.
Or you're increasing your earning potential
Through education.
through education.
Okay.
And bad debt, on the other hand, is typically debt that you use to finance consumption. Or things that depreciate in value really quickly, like, racking up credit card debt for clothes or vacations.
Right. So if you're putting like, dinners out on your credit card and stuff like that.
Yeah, and you're not paying it off right away.
Yeah.
That can really get out of hand.
Yeah. And that high interest debt, that can really eat away at your income.
Yeah, it can make it really hard
And make it harder to reach your.
to achieve your financial goals.
So when it comes to debt management, like what are some key strategies?
Oh, one really important one is to prioritize paying down that high interest debt first.
High interest.
Okay, because that's the debt that's really costing you the most money
Right.
over time.
So if I have like, a credit card with a 20% interest rate and a car loan with a 5% interest rate,
Yeah.
I should be focusing on paying down that
That credit card debt first.
credit card debt.
Another strategy is to consider debt consolidation, which is basically combining multiple debts
Oh, okay.
into a single loan with a lower interest rate.
So if I've got like several credit cards
Yeah, with different balances.
with different balances and interest rates, I could consolidate them into
Usually consolidate them.
like a personal loan
Right, yeah.
with a lower rate.
A lower rate.
And that can help me save money
Yeah.
on interest.
On interest.
And also just kind of simplify things a little bit.
Makes things easier to manage.
Yeah, okay.
Absolutely.
And lastly, let's talk about credit scores.
Credit scores. Yes.
I know they're really important,
They are.
but I don't know if I fully understand how they work.
It can be kind of a mystery.
Yeah.
So your credit score is basically a 3-digit number that represents your credit worthiness.
Okay.
And it's based on your credit history.
Credit history.
So things like your payment history, credit utilization, length of credit history, types of credit, recent credit inquiries.
So it's kind of like a financial report card
Yes.
that tells lenders how responsible you are with credit.
Exactly.
And that score can really have a big impact
Huge impact.
on your financial life.
Yeah.
Yeah.
Can affect your ability to get loans, the interest rates you pay,
Okay.
even your insurance premiums.
So a higher credit score means I'm more likely to get approved for credit,
Yes.
and I'm gonna get better terms on loans,
Lower interest rate.
lower interest rates.
Exactly.
And a lower credit score can make it
It can make it more difficult and more
more
expensive
expensive. Okay.
to borrow money.
So how do we improve our credit scores?
Well, one of the most important things is to pay your bills on time, every time.
Okay. So even one like late payment
It can hurt.
can hurt my score.
It can, especially if it's a recent late payment.
Oh, okay.
So paying bills on time is really crucial.
All right. So that's a big one.
Yeah.
What else can we do?
Another important factor is credit utilization.
Okay.
And that refers to the amount of credit you're using compared to your total available credit.
Okay. So if I have a credit card with a $10,000 limit.
Yes.
And I'm currently using $5,000 of that.
Yep. That's 50% utilization.
50% utilization.
Yeah.
Okay.
And generally speaking, it's a good idea to try to keep that utilization below 30%.
So I should really try to keep those credit card balances
low
relative to my limits.
Exactly, because that shows lenders that you're not maxing out your credit cards and that you're managing your credit responsibly.
Okay, so we've covered a lot of ground today.
Yeah.
From understanding financial statements to exploring those investment strategies to managing our personal
finances. It's all connected.
It really is.
But I think it's important to remember that financial acumen is a journey. Yeah. It's not a destination.
Not a destination.
It's not about, mastering every concept overnight.
It's about learning.
It's about continuous learning, growth, adaptation.
It's about being curious.
Curious, yes.
Asking questions.
Seeking
out, resources that can help you learn and make those more informed decisions.
Absolutely.
And don't be afraid to make mistakes along the way.
Oh, mistakes are part of the process.
That's how we learn.
Yeah.
That's how we grow.
It is.
And improve.
And remember, financial acumen is not just about personal gain. It's also about empowering us to make a positive impact on the world.
Yeah, that's a good point.
It's about using our resources to support causes we care about, to invest in businesses that are making a difference.
Yeah.
And to really help create a more, sustainable and equitable future.
Yeah. That's a great point.
So as we wrap up this part of our deep dive, I want to leave you with a thought-provoking question.
Okay, I'm ready for a challenge.
So we've talked about the importance of setting financial goals, whether it's, saving for retirement or buying a home or paying off debt.
Right.
But sometimes even with those clear goals in mind, it can be tough to stay motivated and on track. We all experience those moments of, financial frustration or discouragement.
We've all been there.
So my question to you is, what are some strategies or tools that you can use to really stay motivated and committed to those goals, even when you're faced with challenges?
Yeah, that's a great question.
Or setbacks.
I think it's important to have like a clear vision of why those goals are important to you. To kind of break down those big goals into smaller, more manageable steps, and to celebrate your progress along the way.
Celebrate the wins.
Right.
It's also really helpful to find a supportive community.
Yeah, like an accountability partner or something.
An accountability partner.
Right.
A financial coach, somebody who can really encourage you.
Like a financial cheerleader.
There you go.
Okay.
And remember, financial success is not just about achieving, a certain net worth or income level. It's really about creating a life of financial well-being.
Well-being. It's about having those resources to pursue your passions.
Exactly.
To support your family and to just live a life
that's aligned with your values.
Yeah, beautifully said.
So as we move into the final part of our deep dive, let's explore some of the broader implications of financial acumen and how it can really empower us to create a more fulfilling and impactful life.
It's really interesting as we kind of wrap up this deep dive into financial acumen.
Yeah.
How much it's really about so much more than just, numbers.
Yeah. It's about that empowerment, taking control of our financial destinies and shaping our lives.
With intention, yeah.
With intention.
It's about aligning our financial choices with our values.
Exactly.
And using our resources to create a life that feels meaningful and fulfilling.
And, it's fascinating to me how this, this whole idea of financial acumen can actually kind of shift our perspective on money itself.
Okay, so how so? Like, how does it change our view of money?
Well, instead of viewing money as something to be, feared or stressed over,
Right.
we can start to see it as
Okay.
a tool that can help us achieve our goals,
Right.
support our loved ones,
Yeah. So it's about kind of reframing that relationship
reframing the relationship.
with money.
Exactly.
And that can be really powerful.
It can. It can be incredibly liberating.
It's like moving from a scarcity mindset to an abundance mindset.
That's a great way to put it.
When we kind of approach money with that sense of abundance, we're more likely to make decisions from a place of empowerment
Absolutely.
rather than fear.
And that can lead to more thoughtful and intentional choices.
Okay, so what are some of the ways that financial acumen can help us create a life that's more aligned with our values?
Well, I think for some people, it might mean prioritizing experiences over material possessions.
Yeah.
For others, it might mean investing in their education or starting a business that aligns with their passions.
It's about having that freedom
Your freedom.
to pursue what matters most.
Yeah, I think that's incredibly empowering.
So as we wrap up this deep dive, do you have any final thoughts or advice for our listener on their journey towards greater financial acumen?
I would say embrace the journey. It's not about achieving perfection overnight. It's about continuous learning,
Growth, adapting.
growth, adaptation.
It's about being curious, asking questions, seeking out those resources that can help you learn and make those informed decisions.
Exactly. And don't be afraid to make mistakes along the way.
Yeah, mistakes are...
Mistakes are valuable learning opportunities.
Yeah, that's how we learn.
Absolutely.
That's how we grow.
Yeah. And remember, financial acumen is not just about personal gain. It's also about empowering us to make a positive impact on the world.
Yeah.
It's about using our resources to support causes we care about, to invest in businesses that are making a difference.
To create a more sustainable and equitable world.
Exactly. I think that's a perfect note to end on.
To our listener, I hope this deep dive has been insightful and empowering. And remember, financial acumen, it's a journey.
It is.
And every step you take brings you closer to a life of greater financial well-being and fulfillment.